Weekly update of the stock market. I'm Rich Paz for Critical Point, Thursday, Jan 30, 8:01 a.m. Eastern Time. All right, let's look at the hourly chart here. And we can see that yesterday the market did decline, and we anticipated that. And I was very pleased how well the market behaved relative to the Federal Reserve. The Federal Reserve did not raise interest rates, and it did imply that it doesn't have to raise anytime soon, that it is a bit concerned of future inflation and the need to raise interest rates. Okay, so today, if the market trades below yesterday's low of 6,012.96 cash S&P 500, I think they're going to consider start putting it down towards the low of the week, and that may discourage them. They're going to put it all the way down eventually to fill the gap back in January 15th, all the way down to 58.60. Okay, so different layers all the way down, and the lower it goes, the next layer they'll consider. On the other hand, the market is trying to bounce here overnight in the futures, and if by chance the cash market at 9:30 a.m. or later today trades above 6057.27, they're going to consider putting it up to yesterday's tiny little trader's gap. They may not even pay any attention to it, but around the 59.60 mark, which will then cause them to consider maybe it's going to go to a new high for the week, taking out 6,074.54 and filling an additional filling of the gap created on the downside this week from the shock of AI. So there's the layers they'll be watching on the way up and the way down to give them clues. What kind of direction does this market want to take? Because right at the moment, you've had the AI drop, and then you got a knee-jerk reaction, and then it's just sitting there, wondering what does it do next, okay? So now let's move to the 6-hour chart for the S&P 500 futures, get some overnight trading information in there, and put in the model analysis. And what we have is this is a level 3 uptrend that occurs during a month, over and done with, and that trend is either down into next Monday, Tuesday for latest for bottom, or if it takes a sudden hit today, tomorrow, but then is up next week, it can bottom today, tomorrow for that level 3, okay? For the moment, it has bounced enough to consider it did place a level 3 bottom on Monday, okay? Therefore, the trend ought to be up into next week, perhaps even the following week, but we're looking primarily for a top next week, and it's probably going to be mid to late next week if it's going up. So do keep in mind this market can go higher. But as we throw in the politics, the Maganomics, the tariffs, as we throw in lingering concerns over AI, we're suspicious this level 3 up move doesn't have a lot of upside. That they'd like to take it higher, but they just don't have enough conviction. They don't see a reason to put it up by huge amounts at least. For the moment, they don't see a reason to actually put it down either. I think they're inflecting, reflecting, they're wheeling, dealing, trying to figure out what do they really want to do farther out. I'm concerned what's going on is even though the economy is going to continue to grow for a while yet, I think they're dialing in businesses holding back unemployment as they wait. I think they're concerned this is not 2017 Trump, this is 2018 Trump, when the market really didn't go anywhere. And it had some nasty down moves along the way, and then it just recovered. And I think it's kind of like backwards from what we saw back then. And the reason is the whole Republican Trump MAGA thing is so wide and deep with their Project 2025, so many things that can go right or wrong, okay? And I think businesses started pulling out in July, especially off that Japan carry trade that upset the financial markets globally. They started pulling out in preparation for election, and they escalated that right in the election. After the election, some of them started to go back to expanding business, hiring, feeling a little more at ease, but it's not a significant number, and even some of those, I think, have backpedaled already. So I think they're concerned. I wouldn't be surprised. We've seen the best employment growth, and therefore unemployment can even pick up. And you know my 4-year forecast of rising unemployment. Some of this is simply just related to laying off so many people in government. and the rest of the country just not willing to take those people immediately. Okay, it doesn't have to be a disaster scenario. It's just something to watch. I think we're also going to see customer support decline in the next 4 years. I think companies aren't going to refund your money as fast as they used to. I think these companies are going to rip you off if they can. You get partial refunds. There's a lot of bad little things that still may not matter to the stock market, but it's going to matter to people, okay? And you know my stance of chance for rising inflation. We do have to be concerned of that, and the Fed Reserve is saying they're at least somewhat concerned. In other words, they think the economy is doing well enough that they don't need to help the economy when there is the risk inflation and tariffs can mess things up and they've got to raise interest rates. So as I look at this blend of things, to me, it seems like they would want to sell by tomorrow, if not starting today, in preparation for February 1 Saturday tariffs on Canada, Mexico. And the Colombia tariffs kind of come and went, and it was just an emotional response from Trump that things weren't going well on the deportation. And by the way, the news doesn't seem to discuss this, but Biden, like last year, deported more people than what Trump has done so far, and it went smoother, easier, okay? And yet people are just... It's just amazing how things are reported and not reported. At any rate, some of that is blowing over. The coffee market exploded. That hasn't blown over, but coffee was already in a bull market for a very long time, and it's like coming to a head now when it exploded like a rocket ship. So I'm not so sure it has a lot to do. It was like the Colombia thing was like the last straw, okay? So I don't know how much to believe in that rally and how far it's going. At any rate, it just looks like it's a moment to be sluggish here, up and down. And this level 3 top due next week, I'm a little suspicious it's actually going to occur at a lower price than where we are now. That it's not going to work the way it normally works. That it's already had its upside even though it's not time to have. And why would it do that? Because I think people are going to continue to backpedal a little bit here and say, you know what, I'd rather not be so active investing. I need to go do something else with my life and ride this out, see where we're really going over the next 6 months this year for the economy. So yes, the level 3 trend ought to be up. And if you're a level 3 trader, you should be bullish in next week. But for me, if I wanted to trade it, I don't want to trade it. Take the time off and go do something else, okay? I just don't think there's much upside here going into that top, and I'm just concerned that they won't like what happens going over the weekend. And Sunday night, Monday, they hit it hard, and then it blips back up a little later in the week, but it doesn't come up as high as what we've already seen, and then it just goes on down yet again. Looking out 2 weeks from now, I can see this stock market down, okay? So that's the level 3. Don't trust it. Now, inside of that's the level 4, and believe the bottom was yesterday. In theory, it can bottom right now, this morning for latest allowed, but it hasn't come down. Miles throwing it out. It's saying probably the level 4 is up into tomorrow. So today can be an up day, and maybe they're going to wake up and get all excited and happy-dappy, and they may want to finish the rest of this tiny gap on the futures where we have a huge gap, or had a huge gap on the cash market. They've closed most of it, but not all of it. So there's upside potential. I don't trust it, okay? And if it starts swinging back to 60-50 in the futures, starts swinging back to yesterday's low in the cash, I think that is a sign this market just doesn't have it. It's trying to be bullish, but it just doesn't have what it takes. It's lost some of its mojo momentum. All right, let's go to the daily chart now and go to the S&P 500 cash. And we can see it bounced off the 40-day moving average, bumped its head on the 5-day average. Interesting how that works. Rolling over on that average as if, yes, we have a level 3 downtrend, and yet we just sit at bottom. Well, they could knock it down today, tomorrow, maybe Monday, Tuesday, then up. There could be one last-minute sell-off for this level 3, then higher. For the moment, though, we're saying, no, it acts like it really would like to go higher, but at the same time, we're saying probably not going up all that well. It's probably going to be a struggle. So starts trading below yesterday's low of 6012.96. I don't think that's a very good sign. and yet it may be meaningless information. Trade below the prior day's low of 5995.07. That's scaring them. The 40-day average isn't working. The 50-day average might not be working. And then if it trades below the low of the week of 5963.02, they're going to become scared. It's going on down to the more famous, well-watched 100-day moving average around 58.69, and it's going to fill that gap made on January 15th. So that would be their downside target, and maybe nothing more than self-fulfilling prophecy, but it may have something to do, they don't like the tariffs, which is the only news I can think of right now that will bother them. Tomorrow we're going to get the PC inflation report. Maybe that will bother them. Today we'll have the an initial jobless claims report, just normal business, and the model's really not paying much attention to it, okay? At any rate, however, again, trade above the high of 6074.54. It's filling more of this gap. And then they might start wondering, is it going to go to a record high, 6128.04? Now, this daily indicator acting bearish as of yesterday. It did not pay any attention to this bounce as if it's determined to continue to go lower. It is a wide enough spread to consider it's going lower. The problem is, it's not wide enough to really feel confident about it. It is narrow enough that it could turn on a dime here and be a secondary buy signal, and it is mid-range. For a quality secondary buy signal, this is where you'd want it, okay? So again, I think if it starts trading above the high of 2 days ago, it's a sign that level 3 trend is up and working, but I question how well it's going to work. And if it trades below yesterday's low, I'm getting concerned it's not working. And if it trades below the low of 2 days ago, I think they're going to become bearish here, that they just don't like how this market's behaving. All right, let's move out to the weekly chart. And let's go first with some outside information here. This is the S&P 500 stocks above the 200-day average. They got all excited and slammed it up even with that drop on Monday because they were buying other stocks than the Mag 7 that they were dumping, and they were dumping NVIDIA, and they were buying the other stocks, and that put them up. But something has occurred here going into the end of the week. It's already back down, suggesting they resold those stocks, or someone else stepped in and sold them, which also means those buyers that bought Monday, they bought all they wanted for a little while. They're watching the market, and someone else come in to sell it. So kind of a surprise how well this turned back down, and making me question, are they having second thoughts about buying that AI drop for those other stocks here, okay? So if we then go with the some of the other indexes here, here's the equal weighted index, and that is turned down, and we may have a level 2 top, and this market's already going down into March. And that is the equal weighted index. That's telling you the other 493 stocks in the S&P 500 that are not as powerful to drive it. Keep in mind, there's only a handful of stocks that pushes the entire stock market higher or lower. And we saw evidence of that it can work against us as it was on Monday with the AI. But here, it's like all of a sudden they're already changing their mind on those other stocks, that maybe they're reselling them, or they certainly aren't buying more and someone else wants to sell it. This is the NASDAQ 100, and granted, a nice recovery after a big slam dunk off the AI, but that could be nothing more than a knee-jerk reaction. It's not that positive. NASDAQ Composite, same story. Might just be a knee-jerk reaction. There's nothing here to tell us it's really all that positive, okay? If we go to the futures and see where are we this morning as of this week, it's a big slam dunk, hammered it, big coming back. I'm a little nervous that was too fast down, but now too fast up. It needs to slide down the pole there a little bit and kind of consolidate and chill out a little bit to figure out what does it really want to do, okay? So now if we go to the Dow Jones, which has been a good indicator of what are they doing with those 493 stocks, yes, nice up move, shouldn't top for level 1, maybe only a level 2, till next week or later, but it's already had a nice run up. I'm already getting questions from people saying, is this a double top for the Dow Jones, meaning sell it? Well, the weekly indicator is acting bullish enough that it's suggesting chance for lingering near-term upside momentum next 1 to 3 weeks. Well, hello, the model's saying really ought to go higher in the next week or later. But this indicator is also overbought, warning how much do you really want to buy? How high do you want to pay? It's warning a top's coming, that the model has a right to look for a sell signal. So I think it's rather limited upside for the Dow Jones. Even if it goes to a new record high, I'm fine with it. I'm still going to call it level one, and I'm going to gamble at calling it long-term top, maybe mid-sized long-term top. And I'm even going to gamble on very, very low probability of a once-a-decade sell signal that could lead to 60% down this year or next. But that would be an extremely rare pattern. Don't have the evidence for it. It's just enough things are set up that it might occur, and that's all you can say. It's kind of on the shelf next to the desk, not really on the desk, okay? So we might look out for those kind of characteristics that can interfere here. So next what we want to do is go with the S&P 500 futures. I haven't shown you that very often on the weekly chart. There's that big slam dunk below the 5-day week average, and what do they tell you? When it's below the 5-week average, you got to be concerned. Will it stay there by the end of the week? Because it's so many times, most of the time, it's a fake out. And what they do, they slammed it right back up on us, showing it's a fake out. Now we need to see if it will close above the 5-week average this week, because that may be a sign they shrugged off some of this negative AI stuff, and the market wants to go higher into next week for a level 2, and now I'm considering a level 1 like the Dow Jones Industrials, and therefore considering yet another minor long-term sell signal, if not mid-size, if not sell signals of for once a decade, okay? So it's likely this market wants to go higher into February like we have been saying, and then pull back into March and then higher into April. But we're picking up signs saying, yeah, well, instead of higher still by April, it may not be that way, okay? That February is the highest price. In addition, it may not go higher into February, that we've already seen the highest it's going to go, all right? So conflicting information is just how they want to trade it. People are having problems figuring out how they want to do it. It looks like they're net bullish, but they're just nervous about the future, what might go wrong. Now, this is the cash market. It pulled back, as we said it would, into this time frame to bottom this week or next, and it looks like it is this week. And then it can snap up into next week to the following week for the next level 3 top, and it looks like it will be just next week. And I'm just concerned it is not going to a record high that was made 2 weeks ago, that something's going to chill it out, cap it off, and it may not even go any higher than what I've seen this week. That's the best I can tell you. That's what we're leaning towards, even though we can be wrong and it can be far more bullish than we think. There's something not quite right with this market for the upside. When it comes back down, what we want to watch out for is a level 1 top is due next week or following. It may only be level 2. I'm fine with that. I just want to consider something far more important can occur. What we thought occurred in December can occur now. Last week can occur here in February, okay? Something more important. What we think is it's going down into March, as we said, and then up into April, then down into May, June. But what we're concerned is this level 2 up move isn't going to amount to much. And what it really wants to do is just go down in April, May. And if you're trying to focus only on level 1s, that is the best forecast. It just ought to go down in April, May. So I'm concerned this could be quite bearish if it trades below the low of this week, 5963.02. Mark that on your charts. Not a good sign if it goes below that. Okay, doesn't mean it can't snap up and shock us for a while, but it can just generally work lower in April, May, and at least ought to move lower into March, okay? So watch out for that. Yes, the weekly indicator is acting bullish, but it is warning, hey, you got to start thinking about a top. Something can go wrong. Something can limit the upside. So we'll try to be open-minded. It's going higher into February. It's going higher in the next week. But at the same time, it just seems like it's not going to be as good a bull run as we're used to, that we would like. And there are things that can go wrong. And again, if it goes below last week's low, not a good story. Now, for the speculative fair valuation, I'm lowering it just slightly. And the reason is I think the market's pretty much over and done with what should still be a good economy for several months. They no longer care. They're looking farther out, saying things are going to slow down. We're going to have to study things a bit more here, and let's be a bit more careful. All right. So that's our best stance is there's a good chance this is going lower in April, May. At the very least, it ought to go lower in March. Yes, it can go higher in the next few weeks first, then down, but we just don't trust it. And if it goes below last week's low, we definitely don't trust the upside. Down, down, down into March. All right. Seems to be the best scenario. Now, interest rates, the market has been trying to shrug off interest rates, not pay much attention. Of course, interest rates backed off and helped the bulls at least, and maybe even concerned the bears how bearish they want to be. Starting next week and later, we're due for a level 1 bottom, and the model is saying it probably is going lower into next week. That could help move the stock market higher into next week. But it'll be interesting the way this interest rate's dropping quickly. So far, the stock market has been rather sluggish for its rebound. It's interesting. We'll have to watch its relationship to interest rates. If it doesn't get too excited off this drop of interest rates, it means it is worried about other things. And then if you take the interest rates back up, and they ought to be up from this level 1 bottom into March, that's going to worry them. That's going to be an additional negative. So the moment, the interest rate should be helping the stock market. Doesn't seem to be helping as much as it should, so something else is bothering the market, okay? But the interest rates are down, can go lower in the next week. That may yet be a catalyst here, a driver, to help push the stock market higher. All right, what's going on with like NVIDIA? Can we get any clues with that? All I can say is that chart looks ugly, okay? It's got a big gap. It can snap back up, but it looks like to me that they should have already rushed in and bought it. They claim the retail investor bought a huge amount of NVIDIA. But professionals assume the retail investor is not that smart or clever. Well, lately, past few years, the retail investor's actually done better than the professionals, but he buys and rides out a lot. It's not really clever buying. All right. The Magnificent Seven, a little stronger, better than NVIDIA right now. And yes, it can work higher on us into February, but it's really, for the moment, it hasn't done anything really for 4 weeks here. It's still reflecting. If it goes back below the low this week, I do not think that's a good sign. I think that's going to be a negative. Something's still going wrong here, at least over with the AI scare that's going on. Okay, so our best stance here is the market's going lower in April, May. It's higher probability and easier to forecast that it's going lower into February, March. But in the near term, it still can go higher a couple of more weeks, can go higher into next week. But we just think there's limiting factors. We think what that's going on is the market is just giving everybody second and third and fourth chances to sell it for some problems down the road, okay? So we're at that, and I don't think I'll discuss the dollar, Bitcoin, and those other markets. They're all showing things. Gold's working higher, so people are still nervous. They still want to buy a little gold here. All right, I think I'm going to get some of the fundamental information, bring that up. And by the way, for potential downside here in coming months, we still want to consider minus 7% to minus 13%. But there's with these minor long-term tops, we may have to consider as much as 30-something% down, probably no more than 20% down. But with the possibility of earlier than normal once-a-decade sell signals, we have to consider as much as 60% down, probably no more than 30%. All right, so those are the things we just layer on top, and top is just a matter of how negative news do we get in the future. All right, this screenshot is basically of the World Trade Index put out by a company in the Netherlands. And we said it ought to start swinging higher here. This is just the most recent years, that it's time for a decade boom cycle on into the end of the decade. And that index is working. So I'm pleased to see that forecast is working. However, it's not increasing very well, and the global economy isn't doing well enough for people. There may be more stimulus by central banks eventually, but I think everybody's concerned, where are we going with Trump and global trade relative to tariffs, okay? So we'll get out of that one. Now, some of these charts I've probably put in too many. This is earnings per share guidance here, and came into 2024. And all we're saying is it looked like things were picking up towards the end of the year for some measurements of our economy and business. And yet now people are nervous. They need to forecast those things of not doing so well in the future. This is a consensus of 67% companies. Earnings per share, again, there's some reason for them to be optimistic, but I think they're now getting nervous. How much do they want to be? How optimistic do they really want to be? This is the non-financial companies in terms of their income. Just might be things you want to stop the screen and take a look at. This is the individual income tax, interesting enough. I still say on a very long-term basis, we're going to see higher taxes over the next 20 years or so, but it ought to be more on the rich. That would be a better way of doing it, okay? And then this is effective federal tax rates. This is just some long-term stuff that we're modeling here. All right, next up we want to go to consumer sentiment, which pulled back here in January. Okay, not as optimistic, but the overall trend is still up from a low in 2024. It's not up as well as it should be from the 2022 bottom. Again, people trying to be more optimistic, but they also realize there's headwinds, there's things that they don't understand. And yes, that can hold us back on how we're going to grow the economy. All right, next up is inflation, and these are just various components of inflation, wages, and trying to really show that when you go on a decade basis, even though we're up 20% on inflation for the decade, at this stage in a decade, we've done this almost every decade throughout the history of the country. So why are we making such a big deal about it? And unfortunately, though, the wrong kind of people are trying to say, yeah, don't worry about it. That makes me concerned. We can be a little too optimistic here. And again, with these tariffs, we might get a surge of inflation when we start to act like the 1970s, which was a bad decade of inflation, okay? And this is Consumer Price Index as well, put out by CNBC. Now, this is the retail sales, and as of last year, people were buying, spending, but they are also careful how they do it. This is just a reminder how well we had it going into last year, or maybe under the Biden term into January, and my presidential performance modeling will take the S&P 500 index performance at the end of this month and apply it to the Biden term in historical terms. I think it's going to come up that Biden was on the low end of the range of Democrats, but still performing better than most of the Republicans and better than the Republican average, interesting enough, but also didn't get the credit for that. And then an interesting little cartoon here of where we're going on the future. And then this one is Stephanie Kelton on the MMT. And you really ought to watch and study what Stephanie Kelton has been discussing. She has a book, she has a movie. I've seen the film. I haven't bought the book, but I've seen other people, what they're writing about it. There's also something called MMT 101. .org, I believe, something to watch. And all it's simply stating is this $36 trillion federal debt that shows up as a minus. It scares people. They have it on a screen in New York City. They've had it there for decades. And it just scares people and makes people a lot more nervous and political here than they should be. Because the reason is really that minus 36 trillion, that's just an accounting entry. Counting people, they're not very good at figuring out the government. Why? Because business people aren't even good. Business people get mad that the government doesn't run things like a business. Well, hello, it's not a business. It's that simple. It's not a business. Now, in my personal opinion, they do things internally that run just like business people, and they even stay with their budgets better than business people. So I call it a different kind of business, and tax revenue is its income, just like if you're running a store and somebody buys your goods, okay? But it's probably better to explain it that it's simply not a business, so don't make it run a big business. It's doing things that business can't do, all right? Under MMT, we then can make too big of a deal out of that federal debt. Because why? That 36 trillion is showing up as minus, but to be fair, what they're doing, and especially the right-wingers, they don't show you the other side of the balance sheet, which is plus 36 trillion. Why is that? Because that 36 trillion was printed and spent by the government and is in our economy. And there was a paper put out back in 2020 during the COVID by Federal Reserve, And it's crazy. It's only 11 pages, and it's interesting. They don't make a big deal of it, but it's right there in black and white. When they made comments, it's quite possible the government can never go broke because it prints the currency. It can print all the currency it wants to stay in business. And it also said comments that leads to say, we probably make too big a deal out of that government debt. And that's the Federal Reserve, okay? But they don't push that idea. I think internally they fight and argue. They have liberals and conservatives as well. I think they fight and argue, and I don't think anybody really knows where to go with it. And they actually put a Federal Reserve guy on the spot. If you watch the video, it's nuts. It's like he stutters, he stumbles, he doesn't know how to answer the question. And people are saying, here, this guy's a professional in this, and he can't answer that question. All right, we're going to debate this for quite some time, but I think the country needs to get on with it and go with MMT, which is basically saying you got to control inflation or MMT doesn't work. And then I say, when you borrow from like economist Mariana Mazzucato, the government should do things. It should create businesses. It should invent new businesses. It should invent things, but it ought to get paid for them. It ought to. We the people should already own some of Tesla, and there's nothing wrong with that. It should be a venture capitalist. All right, the government should get paid back for that stuff. Do you realize your iPhone, practically more than 90% of what's in your iPhone was probably come up with by the government, not Apple? Isn't that wild? It's crazy. All right. Here's another kind of performance study on the rich. And yes, we do have to do something to rebalance this. We're all headed for a real blow up here in today's type of capitalism. It's just not working. It's ready to explode and die. All right. So these are things we're plugging in not only for now, because the point is the tribe amongst MAGA stuff is bringing in a much more aggressive, faster approach that could help in some of these things, but also destroy some things. And what's the net balance, okay? All right, this is the CAPE ratio, and this is something we need to keep an eye on. The CAPE ratio is high enough to suggest there can be issues when the stock market is going to be dropping. I think there's issues that what really is going on with CAPEX is that businesses aren't spending the money to grow because they don't know what to do under Trump and Maganomics right now. And they were pulling back before the election. Some of them started to move forward after the election. Now I think some of those have backed off, but the others have not come on board. This is high enough to be worried there's something that goes seriously wrong with the stock market, and billionaire Warren Buffett is sitting on more treasury notes than the Federal Reserve. Can you believe that? A single investment fund owns more of the U.S. debt, okay, than the Federal Reserve does, okay? He's sitting on a gigantic amount of cash. Why has he done that? He doesn't trust the future. He thinks the stock market's high-priced, and he's looking for bargains someday, okay? Do keep that in mind. Now, he's been working at it for a long time, so you could argue he's been wrong, but he doesn't really watch the stock market that closely. He's interested in individual stocks, and he's not finding the buying opportunities. All right, this is the S&P with all-time peaks in valuation. So what it's saying is, going all the way back to 1929, the stock market is just as high priced as when it crashed back then. No, I'm not forecasting crash. We got a totally different system today. But we can have a heck of a bear market anyways and knock it down quite a bit. It is something to wonder. Okay. Now, I don't think these types of indicators are really good for timing. All right. But they are something to watch. All right. This is business investment. Again, this gets back to CAPEX. And this was put out by Bloomberg. And what it's showing is in 2019, companies were pulling back. They were not investing because they were nervous where Trump was going with this global trade war. And also considering maybe he'd only have one term, and they just didn't want to make very long-term business decisions, investments. It then went negative during the 2020s, and that's just because, or during 2020, that's just because of the recession, okay? And they really pulled back, okay? Then they actually put it on, and what surprised me in 2022, with all the inflation worries and high interest rates, they barreled ahead and spent boatloads of money to build businesses. That helped create this boom of 2023, 2024 in the stock market. But look what they did during 23, 24. You can see this is a leading lagging indicator. They really pulled back. and really aren't spending much now. And what are they going to do in 2025? My guess is they're not really going to spend that much. They're going to have a wait and see attitude. All right. And I'm sorry, that's just another chart of the consumer confidence not doing so well here on a short-term basis. Really hasn't done all that well, but well enough so far this decade, but people are holding back. It's just interesting. We've had one of the better economies in the history of the U.S., but the American people act as though, no, it's not. Okay. All right, so that's what I got, an update of some of the stuff we're noodling with, fooling around with. We're looking at the generation cycle of the last 20 years coming to an end in the next 4 years, something coming to an end from President Reagan to now. We're looking at Strauss and Howe's generation cycle, 1920s, 1930s to now coming to an end. I'm even revisiting Spengler's stuff, like a 1,000-year civilization cycle where civilization's supposed to die but begin a new civilization. I think this is going to be very impressive in the next 20, 30 years. We are going to become a better, nicer people. After all, unfortunately, we may have a few years yet here as we try to find our feet and resolve all these conflicts and complications and problems. We're simply trying to shift gears in a major way, and Democrats need to also wake up. They can't do things the way they've been doing it. They got to get a new thing, and I think that's coming. It's going to be the younger generation that's going to make a breakthrough and get things rolling. Okay, that's it for this week. Let's do a quick review here. What we are concerned, I'm concerned, and have model information data to suggest we should be, is even if it wants to go higher in February, it will still be lower in March. And if it does go higher in February, it might not pull back that month of March. But my problem is there's a good chance NASDAQ Dow Jones topped in December when we said, and it's not going to record high in February. But it's getting close. It may do it. It may catch up with the S&P 500. The S&P 500 went to a record high in January, and that's a little bit of a weird thing. But I'm a little concerned maybe the S&P 500 topped after Dow Jones, NASDAQ, and this thing is ready to go down into March and probably into May, June. Okay, that it's all over. But we can't rule out some last minute blip higher here in February and then down into March, bring it back some, down into May, June. But overall, it may just be down into May, June. And there's all kinds of downside targets, potentials. It could be a small move, could be a large move. But overall, I'm backing off on the fair valuation because of looking way out, 12 months out, and that's looking murky now. Even though we're actually still doing very well right now in the economy, there's things that can slip. Now, at the same time, I want to watch last week's low. Below 5963.02, we need to concentrate on lower into March. We need to consider it's even lower into May, June, although there could be some sizable up moves against it at time on a real brief basis, okay? So if you want to be bullish, be bullish. I'm just warning you, goes below the low this week, not a good sign. And I'm also warning you, I don't think this up move, if there is going to be one, I don't think it's going to be a very good one. All right. And again, then if we flip back here, let me go to the intraday stuff, and I want to touch base on the interest rates. And they are working lower, but it also should bounce maybe by tomorrow and down Monday, Tuesday. And I think Monday, Tuesday on through sometime next week, it puts in a level 3 bottom. And I'm concerned it's going to put that level 1 bottom in. Interest rates are going higher into summer. They go above 4.98. We got problems, okay? Starts trading over 5%. There's going to be some big Wall Street selling stocks, Wall Streeters, okay? And it might even run to 6%. That's probably going to throw us into a recession later this year and the next. And there are people back to swinging on recessions. Some of those seem to have a terrible track record of that stuff, but it is something to think about. Now, inflation, for some reason I don't have my inflation chart. I am concerned the better forecast is rising inflation over the next few years, and we can have a surge of inflation, okay? Now, I think we would have somewhat higher inflation even if we weren't doing the Trump MAGA right-wing stuff. Even if Harris was in office, there'd still be rising inflation. But I don't think it'd be much. This time around, it may not be much with Trump, may be controllable. And they've got some brand new economists that are pretty clever, and they just don't believe it's going to happen, but it looks like on balance they're going to be wrong. Okay, we still have to be concerned of a surge of inflation, and if a surge is over 3.5%, I think the Federal Reserve is going to raise interest rates. They're going to move faster than what I would do. Normally, I would wait to 5% and then say, now we got a problem. But if it goes over 3.5, we still have to consider not only over 5, but it may shoot up to like 13% inflation, higher than what we saw in 2022. That's going to be a 1970s scenario when we went up, down, and up. But overall, for the decade, it was very high inflation. Stock market ain't gonna like that at all, okay? And keep in mind, even though I'm looking for a long-term bottom around May, June, maybe July, it doesn't have to show up to October. So this market can go sideways to down all the way to October. Even if it goes up, it can come right back down. It can have problems and complications. There's a lot of things that can come at us. And the weird thing is, even though we have this gigantic list of negative things and only a few positive things, for the moment, there's still a chance the positive is the net bias and the stock market can work higher. We just got to be quick and nimble at times and look over our shoulders for problems. So I think they're going to bounce that interest rates, and I think that is going to be a little bit of a concern in coming weeks, coming months here. But here's the 6-hour chart again, okay? And it looks like it's doing nothing so far this morning, down a little bit from overnight. And I think it ought to move higher into tomorrow. Then I think it's going down tomorrow because they will be nervous about the weekend. And then I think they can snap it back up next week if things go fine. If it doesn't go fine, we're going to find out that level 3 forecast of up from this week and the next week is wrong. It doesn't work. And the greater focus is it may even go down the next 1.5, 2 weeks. I won't like it if it trades below yesterday's low, and the market's not going to like it if it trades below the lowest price of this week. Past results not necessarily indicative of future results. I'll try to alert you if I'm more confident here on some of these additional long-term sell signals and intermediate sell signals. I've already given you. My stance is you sell rallies. You just keep selling. And if it goes to record high, maybe we'll have to backpedal and jump in on it, try to make a quick buck. But we just want to be cautious when looking out towards May, June. And at least on a shorter term basis, we want to be cautious looking out into March. It's just one of those years that we can try to be bullish optimistic, but we better be looking over our shoulders because this thing could be moving up a hill that's suddenly going to turn into a mudslide. Thank you.